Hello friends, my name is Neeraj Kosharia. I work as a counterparty risk modeler in an investment bank. Today I'm going to talk about equity options from very basics. So let's have a quick look about the topics that we are going to cover in this session of equity options. First, we'll talk about call options, which is the right to buy shares. We'll talk about put options, which is right to sell shares. Then we'll talk about option pricings. Uh, it's very basic understanding of the option pricings. Then we'll talk about moneyness of options. We'll talk about time value and intrinsic value, delta and gamma of options, and then finally we'll discuss Black-Scholes model. So let's start this session on equity options. So what is an equity options? Equity option is a right to trade equities at a predefined price called strike. So, for example, what is a call option? Call option is a right to buy the underlying shares at a predetermined price called a strike. So, for example, if you want to buy Alibaba shares in 1 year's time, and you want to buy it at today's price, um, you will have to buy a call option, and you will have to pay some premium for that, for buying that call option, because market will be uncertain, and whoever sells you this call option is basically taking that market risk. So um, let's have a look at the payoff of equity call options. So if you buy a call option on a share at price 100, at a strike price of 100, uh, it means that if the uh, regardless of what the share price is at maturity, for example, in this example, if we take 1 year as a maturity, uh, regardless of the end price or of the option, you have the right to buy the shares at 100. So you will only exercise this option if the share prices are above 100, because that's when you gain money. If the share prices are already trading below $100, then it doesn't make sense for you to exercise your call option, because the option is not meaningful. So, for example, assume that in 1 year's time, the share price is $150, and since you have the call option at with 100 strike, you can exercise your call option, buy a share at $100, and then you can sell the same share in the market at 150, because the market price is 150. So you buy the share at 100 and sell the share at 150, so you gain $50. So that's why every dollar increase in share price above the strike price will give you um, same amount of gain. So that's the payoff of a call option. So if you put that payoff in a formula, it's basically exercise price minus strike price. So in this example, if this exercise price is 150, your payoff will be 150 minus 100. That's $50. Similarly, if you sell a call option, your your payoff will be negative of the exercise price minus strike. So if you are selling the call option at 100 strike, and if the share price ends up being 150, you lose $50. However, if the share price is 50, for example, um, you don't need to exercise this call option, because uh, market, if the market price is $50, you wouldn't buy the share at $100 using your call option. So therefore, um, below the strike price, call option is worthless, and above the strike price, the call option um, gives you a payoff. However, we'll further see in the pricing sections how the how the share call options still have value, even if it is below the strike price, even if the share price is below strike price. But for now, let's move on to put options, which is a right to sell. So put option is a right to sell the underlying shares at a predefined price called strike. A payoff of a put option is given in this formula: max of 0 and strike minus exercise price. So if you have a put option at 100 strike, option to put the or sell the shares in 1 year's time at $100, you will gain money if the share price is if the share price is $50 at the end of 1 year. So if the share price is $50 at the end of 1 year, you can still sell. You can buy the shares from market at $50 and sell it in your put option at 100. So basically, you gain 50 minus. You gain 100 minus 50 as the payoff of a put option. So that's why the formula of a payoff is strike minus exercise price. Similarly, if you sell a put option, you lose the amount by strike minus exercise price. So hope this one is clear. Now we will move on to the topic of option pricing basics. So there are three basic steps of pricing an equity option. Basically, you have to assume the price distribution of equity price at the end of the or at the maturity of the call option. Secondly, you have to calculate the probability and the payoff of each of the possible share price, and then you have to calculate the total expected payoff. So once you have the total expected payoff, that total expected payoff is the valuation of your equity option. So for the discussion of this session, we are assuming that all the options that we are going to show are maturing in 1 year, and they are European option. What is a European option? European option is an option that can only be exercised on maturity date. So if it is a 1 year maturity European option, you can exercise that option only in 1 year time, not sometime in between. There exists other types of options, such as American option, which can be exercised anytime between the trade date till the maturity date. However, we will discuss the valuation of American option in a separate lecture. So let's try to model a pricing model. Let's try to develop the pricing model of an equity call option. So let's start with the price distribution assumption. So in this illustration, my assumption is that in 1 year time, price will be distributed between 50 to 100. Yeah, to start with, today the current price is 100, and what I'm assuming is that the movement of share price is equally distributed, equally probable in both the direction. So, and of the same magnitude. So today the share price is 100, and I'm assuming that it can either move up to $50 below of today's price or up to $50 above today's price. However, probability of having any of the price in this range is equal. So, so that makes our valuation very simple, and I have chosen this distribution just for illustration purpose. However, it might be evident to you that it is not a most realistic assumption, because uh, we will see what kind of assumptions are more realistic when we talk about Black-Scholes model. But for now, let's carry on with our assumption of uniform distribution. So let's talk about the scenario which we see in the green box here. So since this green box and the orange box have the same probability, each of them have 50% probability of each of them. And since these are uniform distribution, we can basically take a representative average price as the payoff, average payoff of this box. So the average price of this green box is 125, and based on our call option payoff formula, the payoff of this average payoff of this green box is going to be 125 minus 100, and its probability is going to be 50%. Similarly, the average price of this orange box is 75, and the uh, payoff of this average payoff of this orange section is going to be max of 0 and 75 minus 100, which is 0, with a probability of 50%. So that's what is written here. Up scenario, which is the green box, average price is 125, average payoff is 25, and probability is 50%. Down scenario, the orange scenario is having an average price of 75, average payoff of 0, and probability of 50%. So now we have to calculate the total expected payoff, which is 25, which is the payoff of here, times 50% probability, plus 0 payoff of this section times 50% probability. So that's the equation here, and this gives me 12.5 as the value of this option. So if we have 100 as the current price and 100 as strike, its value is 12.5 based on this assumption. However, you would think that, okay, share price is 100 and strike is 100, my payoff should be 0, but that 100 is a current price, not the final price, and its probability of ending up higher gives this option a value more than 0, and that is 12.5. So if you have to buy this option, and if everyone in the market assumes this pricing distribution, the option seller will charge you $12.5 for this option. So that $12.5 is called the premium of an option. Hope I'm clear about this option pricing methodology. Now let's talk about similar option but assuming different current prices. So now we'll talk about in the money ITM or out of the money OTM option. So the diagram in the left is an in the money option, and right is an out of the money option. So the option strike is the same 100, but we are assuming that the current price is 125 today, and and now we if we assume similar distribution that the price can go $50 up and $50 down at a uniform distribution, then we get this kind of two distributions. Since current price is 125 and this section is $75, this section is $25. The probability of this part is 25% and this part is 75%. So what will be the payoff? The payoff of this part is 0 because it's below the strike price and its probability is 25%. So this is this down scenario, and probability of this part is 75% and average price is 137. So that will give you an average payoff of 37.5, and the mark to market will be 37.5 times 75%, and that gives me a value of the option as $28.125, right? So if you buy a call option at 100 strike when the current price is 125, you will have to pay $28.125 as premium of this option. Now let's look at the an out of the money call option. So let's assume that the current price is 75 and we are buying a call option at 100 strike. So if we divide the prices again into an out of the money section and in the money section, or sorry, no payoff section or an payoff section, then the payoff section has a probability of 25 because it is from 100 to 125, and its average price will be 112.5, which will give you payoff of 12.5. So the expected payoff is 12.5 times 25%, and this part will give you a 0 times 75%. So total value of the option will be $3.125. That means if the current price is $75, and then if you want to buy a, a very out of the money option which is at 100 strike, you will still have to pay $3.125 to the option seller. So that's the basics of option pricing. So now you must have realized that even if the current payoff seems to be not there in this out of the money, you still have some value for this option, and this value is called time value because it assumes that with time there is some possibility of share price going above strike price. So that's the time value of an option. So this is at the money call option, and its intrinsic value. Intrinsic value is the let me basically read the intrinsic value definition. The payoff of an option if the exercise price is today's price. So if today's price is 100 and exercise price remains 100, then we will not gain any amount from the exercising of this option. Similarly, if the share price is 120 and strike is 100, then the intrinsic value is $20, and there will be some time value. So this is a chart which you can have a look. I have created scenarios of no payoff and payoff. So basically this gives you 0 and this gives you some value, and then that value is basically 0, 0 0.5, 4.5, 12.5, etc. And it can be broken down into intrinsic value and time value. So if you see the time value is, it grows from 0 to peak when the option is at the money, and then goes down from peak to 0 when the option goes out of the money. So that's a pretty interesting concept about option pricing. Now let's look at a bit more about the behavior of option pricings with the moneyness. So this is so when the strike price is equal to the current market price, the time value is the biggest, and the time value is smaller here when it is slightly out of the money, sorry, slightly in the money, and time value is smaller uh, if the option is out of the money also. So now we have created option value chart here at different current prices. $50 will give you an option price of 0. $60 current price will give you an option price of 0.5, and dollar current price 80 gives you option price of 4.5, and so on. So I have populated the same option prices here. I have removed the steps of achieving into this option value, and then so if you see, 50 gives you 0, 60 gives you 0.5, 80 gives you 4.5, 100 gives you 12.5, 120 gives you 24.5, 140 gives you 40.5, and 160 gives you 60. So the time value decreases as we go out of the money or in the money. Now we look at delta. So what is delta? Delta is the change in option value per change in price. So meaning for per unit change in price of share price, how much will the option value change? So that is basically you take the difference of these two and divide it by the difference of these two. Uh, so so this 0.05 is 0.5 divided by 60 minus 50, and then there is a formula which I have copied downwards, and if you see, the delta starts from 0 and it goes all the way near 100%, which is 1. And what is 1? I mean, what is delta? Delta is the slope of this price curve. This is a price curve which I have plotted, and then this thin red line is the slope, or the tangent of this price curve, and this 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 has an angle of theta with the horizontal, and the tan theta is the delta. So if you Google, or if you already have studied in basic 10 class mathematics, 1045 is 1. So when the option becomes very deep in the money, it becomes parallel to this payoff diagram, and this payoff diagram has an angle of 45 degree here. Yeah, that's about delta. So it goes from 0 to 1, meaning from very horizontal pricing curve to a tilted pricing curve, which is at 45-degree with the horizontal. Now gamma is the change in delta per unit change in share price. So for a bought call option, you will see that the gamma is small, but it's all positive. So that's an observation. You can similarly create gamma of a sold option, and you'll see that it will be negative. And you can do the exercise for put options also. So yeah, I mean, that's the concept of delta and gamma. uh, People typically get asked about delta and gamma in the interviews a lot. And delta and gamma are called Greeks because these are Greek letters. So sometimes you call them as option Greeks, which means delta and gamma. Okay, so we come to the last topic of the session, which is Black-Scholes model. So if you remember, in our basic option pricing, we assumed a very uniform distribution with a finite end of 50 to 150. However, it's not such a practical assumption because share prices don't have a limitation. It can go down to zero, can theoretically go up to infinity. So to have a more realistic assumption, the Black-Scholes gives you a more realistic assumption. And let's read out the assumption of Black-Scholes model. The few assumptions that are listed here are: the option is European and can only be exercised at expiration. No dividends are paid out during the life of the option. Markets are efficient, which means market movement cannot be predicted. There are no transaction costs in buying the options. The risk-free rate and volatility of the underlying are known and constant, and the returns on underlying are normally distributed. So these bottom two assumptions are the most important and crucial ones. So I'll repeat these two again. Risk-free rate and volatility of underlying are known and constant. And secondly, the return of an underlying are normally distributed. So that way, basically, Black and Scholes, two scientists, used normal distribution uh, to predict the probability of share prices at maturity. Basically, the normal distribution has a mathematical function which can be then used to come up with the probability of the share price at different point of time. And then of course you can calculate the payoff of the call option at certain share price. So yeah, so basically what they do is uh, they divide the normal distribution of share price into very thin slices and um calculate the payoff and the probability, and then do an integration of the whole function and come up with a formula. And the formula is a very useful formula which you can find in internet, a lot of websites. However, the purpose of this lecture was to give a conceptual understanding of options. So I'll not be describing the Black-Scholes formula in this lecture. So that's all from my side on equity options. Hope you liked the lecture, and see you again with a new topic next time.